Picture a Tuesday morning. A man named David pulls into the parking lot of a mid-sized accounting firm in Columbus, Ohio. He drives a 6-year-old Honda Accord. He packs his lunch. He has not been on a vacation that required a passport in 4 years. His neighbor thinks he is doing okay. His coworkers assume he is comfortable. His own mother quietly worries that he is not keeping up. David has a net worth of $1.4 million. He has never told anyone. This is not a story about luck. David did not inherit money. He did not found a startup. He did not pick the right crypto at the right moment. He works a job that pays him $90,000 a year, has done so for about 15 years. And somewhere in the quiet, ordinary rhythm of his life, something clicked into place that most people around him never figured out. The strange part is not that David is wealthy. The strange part is how many people exactly like David there are. Right now, in suburbs and mid-sized cities all across the country, driving used cars, packing lunches, quietly accumulating wealth at a pace that the financial media almost never talks about because it is not dramatic enough to sell advertising. This is the story of how they did it and why almost no one around them noticed. We are living through one of the most confusing wealth moments in modern history. On one hand, the cost of everything has gone up. Housing, food, insurance, college. The math of middle-class life feels tighter than it did a generation ago. And for a lot of people, it genuinely is. On the other hand, the United States added more millionaire households in the last decade than in the previous 3 decades combined. The Federal Reserve's Survey of Consumer Finances, which is released every 3 years and which almost no one actually reads, tells a story that is quietly astonishing. The number of households with a net worth above $1 million has grown dramatically, and the majority of them are not executives, not doctors, not tech workers in San Francisco. They are teachers, middle managers, nurses, small business owners with unglamorous businesses, couples with 2 ordinary incomes and a long enough runway. And here's the part that should bother you if you are paying attention. Most of the personal finance content produced for these exact people tells them to cut their coffee. It tells them to budget harder. It tells them that the secret is discipline and sacrifice and grinding.
And hustle. It treats wealth accumulation like a willpower contest. But the people actually doing it, the Davids of the world, mostly describe it differently. They describe it as almost mechanical, almost boring, like setting something in motion and then mostly leaving it alone. So what is actually happening? What is the mechanism? And why does it work for some people and not others, even when the income levels are almost identical? Let us slow down and actually look at the math. The first mistake people make when thinking about this is assuming that income is the engine. It is not. Income is the fuel. The engine is something else entirely. Here is a fact that tends to land hard when you first encounter it. 2 households with identical incomes, identical cities, identical family sizes, can have net worths that are $1 million apart after 20 years. Not because one of them made better stock picks, not because one of them got lucky with real estate, but because of a handful of structural decisions made early on that compounded quietly in the background while life went on. The research on this is fairly consistent. Thomas Stanley spent decades studying actual millionaires, not celebrity ones, not tech billionaires, but the quiet ones. And his consistent finding was that income explained surprisingly little of the variation in wealth. The correlation between high income and high net worth was much weaker than most people assumed. What explained wealth accumulation, far more reliably, was the gap between what people earned and what they spent, and what they did with that gap. Economists call this the savings rate, but that term undersells what it actually represents, because it is not just savings. It is the width of the pipe that feeds the machine. And the machine, when given enough time, does something that should seem impossible, but is simply mathematics. It multiplies. Most people have heard of compound interest. Most people think they understand it. Most people dramatically underestimate it. Here is why. The human brain is wired to think in straight lines. If something grows by 10% a year, we intuitively model it as going up by 10 equal steps. But that is not how compound growth works. Compound growth is exponential. It bends upward, slowly at first, and then so fast it almost looks like a glitch. Let us run the actual numbers, because the numbers are the story. If you invest $500 a month, starting at age 25, with an average annual return of 8%, which is roughly the historical average of a diversified stock index fund after inflation adjustments over long periods, by age 65, you have about $1.7 million. $500 a month, 40 years, $1.7 million. But here is the part people miss. Of that $1.7 million, you contributed roughly $240,000 out of pocket. The remaining $1.4 million was generated by returns on returns on returns, by the machine eating its own output and growing. Now, run it at $1,000 a month. Same time frame, same return. You land at just over $3 million. You put in roughly $500,000. The machine made $2.5 million. The math does not feel real until you see it, and most people never sit down and actually look at it. Now, here is where the middle class piece becomes interesting, because $1,000 a month sounds like a lot. For a household earning $60,000 or $70,000 a year, that is a stretch. But for a household earning $90,000 or $100,000, which is increasingly what two-income households in mid-tier cities earn, it is not impossible. It is uncomfortable maybe, but not impossible. The households that do it are not doing it by being heroic. They are doing it by making one or two structural decisions that remove the choice from the equation entirely. Ask someone like David how they built their wealth, and the answer is almost always some version of the same thing. I never saw the money. What this means, practically, is that the investment contribution came out before the paycheck hit the checking account, through a 401k contribution, through an automatic transfer to a brokerage account on the same day as every pay period, through a system that made saving the default and spending the exception, rather than the other way around.
This sounds almost insultingly simple, and it is simple. That is the point. Behavioral economists have spent decades studying why people fail to save, even when they intend to. The answer, almost universally, is not lack of willpower. It is friction and visibility. When money is in your checking account, your brain counts it as available. When it is not in your checking account, your brain adapts. Your lifestyle calibrates to what is visible, and the invisible money compounds in the background. This is sometimes called paying yourself first, which is a phrase so overused it has been drained of meaning. But the mechanism underneath it is real and it is powerful. The second thing these households tend to do is something that sounds obvious, but almost no one executes consistently. They avoid the two biggest wealth destroyers for the middle class, which are car debt and lifestyle inflation. Car debt first. The average American household spends roughly $700 to $900 a month on vehicle payments when you account for both cars in a two-car household. For a household earning $90,000 a year, that is roughly 12 to 14% of gross income going toward assets that depreciate by 15 to 20% in the first year and continue declining. It is, financially speaking, a slow bleed. Not catastrophic enough to notice in any single month, devastating over decades. The households building wealth quietly tend to drive older cars. Not beat-up cars, not unreliable cars, just not new cars. The difference in cash flow over a decade can be staggering. Lifestyle inflation is subtler and in some ways more dangerous. When income rises, which it does for most people over the course of a career, the natural tendency is to expand spending proportionally. Better apartment, nicer car, more dining out, fancier vacations. This is not irrational. These things bring genuine pleasure. But the households that end up wealthy in their 50s tend to be the ones that allowed their lifestyle to inflate slowly or selectively, while routing the majority of income increases directly into investments before those increases became part of their mental baseline. David got two meaningful raises over 15 years. He upgraded his apartment once. He did not get a new car either time. His coworkers got the same raises. They moved to nicer neighborhoods. They leased new cars.
Their lifestyles expanded to fill the new income almost immediately. 10 years later, the gap in net worth between David and an equivalent colleague was over $400,000 from the same job, from the same income history.
From different defaults. Now let us talk about the actual investment vehicles, because this is where a lot of people get confused or intimidated and then do nothing, which is the most expensive mistake of all. The households building significant wealth through ordinary income tend to use three main structures. The first is the employer-sponsored 401k, particularly when an employer match is involved. A matching contribution is the closest thing to free money that exists in personal finance. If your employer matches 50% of contributions up to 6% of salary, and you are not contributing at least 6%, you are declining part of your compensation. This is not a hot take. This is arithmetic. And yet roughly a third of eligible employees with access to a 401k either do not participate or do not contribute enough to capture the full match. The second vehicle is the Roth IRA, which has a particular advantage for people who expect to be in a higher tax bracket later or who want flexibility. Contributions go in after tax, but growth and withdrawals in retirement are completely tax-free. For a 25-year-old putting in the maximum contribution each year and not touching it until retirement, the tax-free compounding over 4 decades is worth more in after-tax dollars than almost any other legal mechanism available to ordinary earners. The third is a taxable brokerage account, which sounds less glamorous but becomes important once you have maxed out tax-advantaged accounts. Invested consistently in low-cost index funds tracking broad market indices, this account grows quietly and provides flexibility that retirement accounts do not. Low cost is not a throwaway modifier here. Expense ratios on index funds from Vanguard, Fidelity, or Schwab tend to be between 0.03 and 0.10% annually. Actively managed funds often charge between 0.05 and 1.5%. Over decades on a large portfolio, that difference in fees compounds into tens or even hundreds of thousands of dollars. The households that know this use index funds almost exclusively. The households that do not sometimes hand a significant portion of their potential wealth directly to fund managers in exchange for performance that the data consistently shows is worse than the index itself. None of this is exotic. None of it requires a financial advisor charging a percentage of assets. None of it requires timing the market or picking individual stocks or having any particular insight about the economy. It requires 3 things: a consistent savings rate, automatic execution, and time. Here is where it gets interesting.
The median 401k balance for Americans near retirement age, in their late 50s and early 60s, is somewhere around $185,000 to $200,000, depending on which survey you look at. The average is higher, around $330,000 to $380,000, but averages are distorted upward by people with very large balances. The median tells you what the person in the middle actually has. $200,000, by the time you account for required minimum distributions, taxes, healthcare costs, and inflation, is not enough to retire comfortably for most people. It is a 3 or 4 year buffer at best before Social Security becomes the primary income source. Meanwhile, the households we have been talking about, the Davids, the ones who automated a consistent investment habit in their 20s and 30s and did not catastrophically disrupt it, are sitting on 8, 10, 12 times that. So what happened to everyone else? A few things. Some people started late. The math of compounding is brutally unforgiving about starting late. Someone who begins seriously investing at 45 and retires at 65 has 20 years. Someone who started at 25 has 40 years. The difference in outcomes is not double. It is roughly 4 to 5 times. The early years are the ones that do the heaviest lifting, not because you are investing more, but because those early dollars have the most time to multiply. Some people cashed out their retirement accounts during job transitions. This is more common than it should be and more expensive than most people realize. Cashing out a 401k before retirement triggers income taxes plus a 10% penalty. But the real cost is not the immediate tax hit. It is removing those dollars from the compounding machine at the moment they had the most runway. A $10,000 withdrawal at 35 does not cost $10,000. When you model what that $10,000 would have become by 65 at historical market returns, it costs closer to $100,000.
Some people simply never raised their contribution rate as their income grew. They started contributing at 3% of salary in their late 20s, and when life got expensive and complicated, they never updated the number. 3% of $90,000 a year is $225 a month. Over 30 years at 8%, that is $339,000. Solid, but not transformational. The jump from 3% to 15%, which is what many of the wealth building households end up contributing over time, is the difference between comfortable and genuinely wealthy. The math is not cruel, but it is indifferent. It does not care about your intentions. It only responds to actual contributions and actual time.
The median 401k balance for Americans near retirement age, in their late 50s and early 60s, is somewhere around $185,000 to $200,000, depending on which survey you look at. The average is higher, around $330,000 to $380,000, but averages are distorted upward by people with very large balances. The median tells you what the person in the middle actually has. $200,000, by the time you account for required minimum distributions, taxes, healthcare costs, and inflation, is not enough to retire comfortably for most people. It is a 3 or 4 year buffer at best before Social Security becomes the primary income source. Meanwhile, the households we have been talking about, the Davids, the ones who automated a consistent investment habit in their 20s and 30s and did not catastrophically disrupt it, are sitting on 8, 10, 12 times that. So what happened to everyone else? A few things. Some people started late. The math of compounding is brutally unforgiving about starting late. Someone who begins seriously investing at 45 and retires at 65 has 20 years. Someone who started at 25 has 40 years. The difference in outcomes is not double. It is roughly 4 to 5 times. The early years are the ones that do the heaviest lifting. Not because you are investing more, but because those early dollars have the most time to multiply. Some people cashed out their retirement accounts during job transitions. This is more common than it should be and more expensive than most people realize. Cashing out a 401k before retirement triggers income taxes plus a 10% penalty. But the real cost is not the immediate tax hit. It is removing those dollars from the compounding machine at the moment they had the most runway. A $10,000 withdrawal at 35 does not cost $10,000. When you model what that $10,000 would have become by 65 at historical market returns, it costs closer to $100,000. Some people simply never raised their contribution rate as their income grew. They started contributing at 3% of salary in their late 20s, and when life got expensive and complicated, they never updated the number. 3% of $90,000 a year is $225 a month. Over 30 years at 8%, that is $339,000. Solid, but not transformational. The jump from 3% to 15%, which is what many of the wealth building households end up contributing over time, is the difference between comfortable and genuinely wealthy. The math is not cruel, but it is indifferent. It does not care about your intentions. It only responds to actual contributions and actual time.
We cannot talk about middle-class wealth accumulation without talking about housing. But we need to be precise about what role it actually plays versus what people believe it plays. For a lot of middle-class households, home equity ends up being the largest component of net worth. The home they bought in their 30s, paid down over decades, and now own outright or nearly outright represents a significant store of value. But here's the nuance that gets lost in the enthusiasm around real estate. A primary residence is not primarily an investment. It is a place to live that happens to store value and protect against rent inflation over time. The actual returns on residential real estate, when you account for property taxes, maintenance, insurance, transaction costs, and inflation, are historically much lower than the stock market. Robert Shiller, the economist who won a Nobel Prize partly for his work on asset prices, has tracked real home prices in the United States going back over 100 years. The real inflation-adjusted appreciation is roughly 0.5 to 1% per year over the very long run. That is not nothing. A home that you gradually own more and more of in a neighborhood that holds its value is a meaningful asset. And the leverage involved, using a small down payment to control a large asset, amplifies gains in a way that accelerated equity building for millions of families over the past decade as prices ran. But it is not the engine.
For the households with the largest net worths built on ordinary incomes, the home is usually the floor, not the ceiling. The investment portfolio is doing the heavy lifting. The dangerous version of real estate as wealth strategy is the household that maxes out its budget on a house, treats the mortgage payment as their primary wealth building mechanism, and does nothing else. This household is asset concentrated in an illiquid, expensive to maintain, transaction cost heavy vehicle that they also happen to live in. If they need liquidity, they have to borrow against the house or sell it. Meanwhile, they have little or nothing in investable assets.
The households building diversified wealth tend to own homes, but they did not buy the biggest house they qualified for. They left room. They used the room. Let us take a moment to talk about the noise. At any given moment, there are dozens of YouTube channels, newsletters, podcasts, and social media accounts telling ordinary people that the path to wealth runs through individual stock picking, options trading, cryptocurrency, short-term real estate flips, dropshipping businesses, and whatever other vehicle has recently produced spectacular results for someone somewhere. The testimonials are real. The results are selective. For every person who made $100,000 trading options in a good year, there are dozens who quietly lost their savings attempting the same thing and did not post about it. This is not speculation. It is what the data consistently shows. Studies of retail investor accounts at brokerage firms find that the majority of active traders underperform a simple index fund over any meaningful time horizon. The majority, not a slim majority, the overwhelming majority. The irony is that the boring strategy, the one that does not make for compelling content, the one that has no dramatic turning point and no clever insight, outperforms almost everything that is aggressively marketed to ordinary investors. Index funds do not have good stories. They do not have characters. There is no protagonist, no tension, no reversal of fortune. You put money in, time passes, the money becomes more money. Repeat. This is deeply unsatisfying to a brain that has been trained by media to expect narrative. And financial content creators understand this. So they sell narrative. They sell the excitement of a trade, the possibility of a shortcut, the dream of acceleration. And in doing so, they systematically draw people's attention away from the thing that would actually make them wealthy. David does not have a YouTube channel. He does not have a story. He just has $1.4 million. Now, let us be honest about what could go wrong, because there are real risks here, and a responsible accounting of this strategy requires naming them. The first is sequence of returns risk. This is the risk that a major market downturn happens right at the moment you are about to retire, or just after. If the market drops 40% the year you retire, and you begin withdrawing from a diminished portfolio, you can permanently impair your financial position in a way that a mid-career worker would not experience from the same downturn. The 40-year-old rides it out. The 65-year-old drawing income from the portfolio cannot always wait. This is real, and it requires planning. Most wealth advisors recommend shifting some portion of investments into more stable, less volatile assets as retirement approaches, precisely to reduce this exposure. The second risk is what we might call the plan disruption, a medical catastrophe, a divorce, a period of long-term unemployment. These events can crack the compounding machine in ways that are very hard to repair, particularly in the middle decades, when withdrawing from retirement accounts carries those steep penalties and taxes. The households that are most resilient to disruption tend to maintain a separate emergency fund, 3 to 6 months of living expenses in cash, outside the investment portfolio entirely. This feels like an inefficiency when markets are performing well. It is a lifeline when they are not. The third risk is the one that nobody really wants to talk about, which is the systemic risk. The 8% historical average return on equities is a historical average. It is not a guarantee. It is not a law of physics. It reflects the performance of American capitalism over roughly a century through world wars and depressions and pandemics and pandam shifts. Whether that trajectory continues over the next 40 years is genuinely unknown. Most financial planners still model long-term equity returns in the 5 to 7% real range for planning purposes, which is more conservative than the historical average. At those returns, the outcomes are less dramatic, but still compelling. The math still works, but it works less automatically, which means the margin for error is smaller. Here is something worth sitting with.
The Federal Reserve estimates that somewhere around 15% of American households now have a net worth above $1 million. That sounds like an elite club, until you realize that 15% of American households is somewhere around 20 million households. 20 million households with a net worth above seven figures. This is not old money. Most of it is not inherited. It is not hedge fund managers and real estate moguls. It is, in large part, the compounded result of ordinary incomes invested consistently over long periods in broadly diversified
Markets. The democratization of low-cost index fund investing, which really became accessible to ordinary people in a meaningful way in the 1990s and accelerated sharply in the 2000s and 2010s, has produced a quiet wealth revolution that does not appear on magazine covers because it does not photograph well. There is no Lamborghini. There is no penthouse. There is a modest house with a paid-off mortgage, a brokerage account that the owner checks maybe once a quarter, and a slowly dawning realization sometime in the mid-50s that the number on the screen has become something they never quite planned for. That is the secret, to the degree there is one. Not secret in the sense of hidden, secret in the sense of unspectacular. Too dull to market, too slow to trend, too reliable to need anyone selling it. David retired last year at 61. He sold his house, bought a smaller one in cash, and moved to a mid-sized city with better weather. His investment portfolio generates enough in withdrawals, using the standard 4% withdrawal rate, to cover his living expenses with money left over. He is not rich in the way the word usually gets used. He does not have a staff. He will not leave his children a dynasty. But he will never run out of money. He will never need to ask anyone for anything. He woke up at 61 with more financial freedom than 90% of the people who earned more than him over the course of his career. And here is the question that I keep coming back to, the one I do not think has a clean answer. How many people right now are one or two structural decisions away from ending up in that position and are instead spending their attention on things that will never get them there? Not because they are lazy or uninformed, but because the thing that would actually work is so quiet, so undramatic, so completely devoid of anything that feels like a winning move in the moment that it never competes for attention against everything that does. The machine is not complicated. It has been running for people who found it for decades. The uncomfortable question is not how it works. The uncomfortable question is why, knowing roughly how it works, so few people actually turn it on, and whether you, watching this right now, are still going to be asking that question in 20 years.